Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all viewers to the second session on impairment, where we are going to talk about the analytical aspects related to the impairment. Now, before looking at things that we are going to cover, let's take a quick summary of what we have already done in the previous session, wherein we had talked about what is impairment. We have talked about different key terms. We have also talked about how to impair and the rules which are different in the US GAAP and IFRS. What we are going to talk about right now is when to check for impairment, the impact of impairment on ratios, and the separate rules for assets which are held for sale. In the previous session itself, I have also done how is the reversal possible or not, wherein we said under US GAAP it is not possible and in the IFRS it is, and how is impairment different than depreciation. So these 2 points as well we have covered in the first session. So point number 2, 6 and 7 is what forms the subject matter of discussion now. Let's jump on to the periodicity part of it as to when do we test for impairment. Do we test for impairment on everyday basis? Do we keep worrying about our health of the asset on a every month-to-month basis? The answer is no. Well, to simplify things, I have categorized all the assets into tangible versus intangible first, and then infinite versus finite life. Now here, the idea is that tangible assets in any case will be tested for impairment only when you get a signal. Just by signal, what I mean that there is decline in the usage rate, the decline in profitability, a negative change has happened in the environment. Now, any bad news would have come to you. That means unless and until there is a bad news, you don't need to worry about the health of your assets. You can keep on simply depreciating it, and that's about it. However, in case of intangibles, the rules are a little different between the finite life ones and infinite life ones. The infinite lives, which are like the goodwill in particular, needs to be tested even without a bad news. The idea is that it's like a it's got two negativities in it. First, it's an intangible, which are anyways an abused form of wealth, and second, it has got infinite life. So it's almost like a pimple over an ulcer, which basically says that there are two negativities which are really very difficult, and from an auditor point of view or even from an analyst point of view, hence the law has mandated that this is the most abused form of wealth, not in particular goodwill, but a combination of these two aspects, and therefore you got to test it at least annually, or should I say every time when you prepare your balance sheet, which is generally the annual, or in some cases it is quarterly as well. So it got to be every time when you're going to make your financial statement, even without a bad news coming to you proactively. However, intangible with a finite life has got only one of the bad news is that it's an intangible. It's a little, but yes, abused form of wealth, but not so risky. Therefore, we club it with the previous category of tangibles. Okay, so here on the slide, we are not answering how to impair. We are not answering what to impair. We are answering when to test for impairment. When should I go to the market to check whether the estimates which I had, which is my book value, and the estimates that the market would have are different. So that's the answer that we need to give. Moving on to a very special category of long-lived assets which are held for sale. Now you would be confused that generally we call inventory as something which is held for sale, because your long-lived assets are generally held for use. Let's say a normal business would not make money by selling the plant and machinery. They would want to use it to produce inventory, using which they will generate sales. However, the specific context here that we are saying, the asset which is initially that was purchased for use but perhaps has been replaced by a new asset. The moment you purchase a new asset, your older asset now will no longer be held for use, but now will become held for sale. And to understand this, we don't have to go very far. If let's say I have a particular mobile phone which I have been holding it for use. The moment I purchase another a new phone, because of which my older phone is now held for sale. I can't use two phones at a time. That's a replacement decision, as a lot of people will recall in case of capital budgeting. That is a category of long-lived asset which is held for sale. So short point, it wasn't purchased to be sold, but as a matter of chance, either it has lived its life or it has been replaced by a better asset. The takeaway for us from an accounting standpoint is that the moment the change in classification happens from use to sale, point number A, this may not happen always on 31st of December. A normal impairment is always charged at the end of the year, whereas this change in the classification might happen at any point in time. The second aspect here is that this also will go to an income statement like the normal impairment loss. The third and a little different aspect is the formula. The formula is the net book value, which is similar to be compared with the net realization value. The net realization is the value which is, although pretty similar to what we have been doing so far, fair market value, which is to say your value that you're going to get or take home while selling the asset today. The question is, why do we use NRV to benchmark an asset which is held for sale? And the answer is there in the question itself, that since the asset will now be held only for the purpose of sale, I'm going to compare the selling value to market and impair it at the same time. Let me take a quick question. It was 15th of November where you had purchased a new asset, so the intention change, this is where an impairment loss testing will be done. Obviously, I'm not sure whether I'm going to get an impairment loss, but yes. Now on 31st of December, again I have to make my final accounts, on the date of which again I will mark to market, and on the date of which again I'm going to check with the new net realization value, because in the 45 days time the market value of the asset might have gone up or down. So I will have to mark to market at every point in time at the time of making the balance sheet. The good news here is that, like IFRS, the US GAAP also allows you to reverse the impairment loss, obviously to the extent charged earlier. So which means to say, if you have reduced the value of an asset by 15,000 on 15th of November, for that matter, on 31st of December, you can jack it up maximum to the possible potential of 15,000. So that's a special category of long-lived assets which are held for use. Again, very critical from exam point of view. And moving on to the almost the last aspect, which is the impact on financial ratios. Very critical again. It says an impairment loss. Now the entire analysis is based on what happens to the accounting equation when you impair the asset. Your profit and loss account goes down, and your property, plant and equipment, the net book value goes down. Okay. Now, since your P&L has gone down, your incomes for the year goes down, your assets for the year goes down, and ultimately this P&L will form part of the comprehensive income and will reach your equity. So your equity also has gone down. The question is, in terms of the asset turnover, I am leaving ROA for that matter. The asset turnover ratio is sales upon net book value. Because of the impairment, you can see that there is no sales which is being impacted. So my numerator is constant and my denominator goes down, as a result of which my overall ratio goes up. So the asset turnover ratio will appear to be going up. The next aspect here is in terms of the leverage ratios, which is like debt to equity. You can see here that there is no debt. Therefore, the numerator again being constant, your denominator equity goes down. Therefore, the overall ratio goes up. So the leverage ratios also go up, and the perceived riskiness of the company increases. What is also very critical is the future depreciation and income, and I want you to take very close note of it, that the moment you are going to reduce the net book value, the portion that needs to go to the depreciation in future years will also go down. What I mean by that, let's assume there is a asset of 30,000 which has got 5 years of life. We are using straight line method, so 6,000 is the depreciation that we'll have to charge till T2. I have written it down to 18. This portion, let's say, has undergone the impairment of, let's take any number for that matter. Let's take a number of 3. So the net book value on the second year end is 15. That's the impairment loss, which will result into this, this and this. In the third year, I will have 15 as the opening book value. Now the key point is the future depreciation will become 5 because 15 needs to be depreciated over 3 years. 15 minus salvage value divided by 3. You can see that there has been a fall in the depreciation of 1. So the future depreciation because of the impairment has gone down. Again, a very quick reconciliation. The fall in the depreciation is 6 minus 5 is equal to 1. For 3 years, the total fall is $3, which is nothing but the impairment that you've charged. So in a way, the impairment means bringing forth the future depreciation, resulting in lower depreciation and higher income. So in your exam, be very mindful of whether we have to use the analyze the future return on asset or current return on asset. Jumping on to the return on asset, which is your profit after tax divided by net book value. The impact of impairment is same. Let's say it goes down by 3 in the numerator and it goes down by 3 in the denominator as well, because that's what is the impact here, 3 and 3. The key part here is, since this ratio, return on asset or return on equity for that matter, are less than 1, the denominator is obviously heavier than the numerator. The same dollar change in a decrement form would pull the numerator more proportionately, and the denominator will be also pulled by the same number, but in terms of the proportion, it will have different impact. So what I'm trying to say is that your y is greater than x. Let's just quickly illustrate. Let's say a ratio 10 upon 100. If I reduce both by 9, same dollar amount, it becomes 1 upon 91. So 1 upon 91 obviously is much lower compared to the original ratio, just because the numerator is smaller and a similar dollar impact is going to pull it down further. So short point is, before impairment and after impairment, your ROA becomes much lower afterwards. Okay. So I hope that this session was useful in completing the concepts of impairment. The next session, the third and the last on the series of impairment, we have a lot of questions based on impairment. I want you to kind of quickly see that as well. A very short video to be followed. This was Ankur Kulshrestha signing off for now. Looking forward to speak to you in my next session. Thank you.